All right, so for today's class, we are going to talk a little bit about candlesticks and about some patterns. We're going to start a little bit talking about the candlesticks. As everyone knows, this is the candle. It can be green candle or red candle. So candlesticks is the way of displaying information about an asset price movement. When we see green candles, that means this asset price is going up. When we see red candles, that means the asset price is going down. And as you all know, the candle has three basic features. The first thing is the candle body. This is the body of the candle, which is a present open to close range. What does that mean? When it's a green candle, the bottom part of the body, it's where the candle opened. When it's a red candle, the upper part, the upper end, is where the candle opened. Then we have the wicks. This is the wicks, the one on the top. The wicks indicates the intraday high and low. And this situation and this candle situation means we opened right here. At some point, the sellers, they pushed it all the way down here, then push it all the way up back there. Then it closed right here. And then of course, it's the color. The color reveals direction of the market movement. Green candle mean the price is going up. Red candle mean the price is going down. And as we know, the candle patterns are used to predict the future direction of the price movement. Today, we're going to talk a little bit about some candlesticks patterns. All right, the first one we're going to talk about is the hammer. The hammer candlesticks pattern is formed of a short body with a long lower wick. As you see right here, usually we form this candle when we're in a downtrend, and now we're going to flip to an uptrend. You will see a long wick from the bottom, then a full green body on the top, which is mean that at some point, this candle was a huge red candle. It hit this point and it reversed all the way up here. I really like to trade hammer because I think it's easy to trade, especially when you're watching it on like 15 minutes, 30 minutes, or freaking like an hour, 4 hours. I mean, you need a healthy market condition for that hammer to work. Anyone have a question about the hammer? Are you guys familiar with the hammer? All right, so the hammer candlesticks pattern is formed of a short body, as you see, small body on the top, and the bottom, a longer wick from the bottom. And it's indicate that the downtrend might flip. All right, now we'll go to the next. The next one is the inverse hammer. It's similar to the hammer, except it's an upside down. You will see a huge wick from the top with a green body on the bottom. The only difference is the upper wick is long than the lower wick. Like you'll see a huge wick from the top and a huge wick from the bottom. No, not every hammer will work, but the hammer indicates that at this price level right here, there is a lot of buying pressure. Like there is a downtrend, then we hit this specific price, and now we start seeing a movement to the upside. But no, now we're going to talk about patterns, and we're going to talk about candlesticks. Some of them, they're reversal patterns, and some of them, they're continuation pattern. And it's better to use it in the right way. So some of them is bullish, some of them is bearish. Where when we're in a bull market, we only use the bull patterns. When in a bear market, we only use the bearish pattern. Uh, I watch the tape, but I'm not really good at reading the tape. Usually I just watch the tape when I'm breaking when we're breaking like a major level. And it does work on all time frame. I don't really use it on like a 1 minute or 2 minute, but if we're playing like intraday, like we just opened right here, sell off, sell off, sell off, sell off, a little bit of consolidation, then more sell off, then the hammer start forming on the 5 minutes. Yeah, maybe I'll use it. It's depend on the volume. With the hammer, you always want to see a volume kicking in, followed by another green candle. But for in the bear market, as we all see, the hammer is not really working as it used to be. We have now the inverse hammer, which is similar to the bullish pattern. The only different is the upper wick long on the top and the lower wick is short from the bottom, which is right here. As you can see, it indicates the buying pressure. As you see right here, there is a buying pressure that was not strong enough to drive the market price down. The inverse hammer suggests that the buyers soon will have control in the market. What does that mean? That's mean you'll see like a downtrend, then you'll see a huge green candle, then the candle then it start forming a long wick from the top, but it close as a green candle. What does that mean? That's mean as we see like a downtrend, all green candles, then we saw one huge green candle, then the body close on the bottom, which is mean there is still a selling pressure right here. They pushed all this wick, but since we close in a green body, that's mean the buyers might hop in soon. With the inverse hammer, you always want to see the candle that follow it. You want to see at least a green candle closing above the half of the wick, which is right here. If this candle is followed by green candle close right here, this is not good. You always want to see close above the 50% of the wick. As in this situation, it closed above the 50% of the wick. Anyone have a question so far? You can unmute yourself and talk to me if you want to.
Question.
Go ahead.
So it's definitely, even though this happens here with the selling pressure, going down and then it pops up, it could be possible that it just quote unquote kind of fakes you out and just still pushes down.
Yes, but this wick, it shows that the buyer might be right here. That's why I said you want to watch the following candle. And this candle will show you that when we hit this point, we start seeing some buying pressure, push it all the way to the top. Then the sellers push it back down. Since we close a green body on the bottom, we watch the candle right next to it. If the next candle closed above 50% of the wick, this is where you want to find an entry, right after this close.
So one more question. This happened to me on Tesla on Friday, where I thought it was going down and it bounced back and just consolidated. But to be proper, like let's say I did want to entry into a put there because I thought it was good, I should have just set a stop loss correctly, so that way I would have just got stopped out.
On which time frame you were watching the candle forming?
I was watching the 3 and the 5.
So you choose your entry based on the 5 minutes. You saw this type of candle. Did you watch the second candle, or you entered on?
I entered right there
on this candle.
Yep.
This is not a good entry. You want to wait
because I saw because I saw the quote unquote selling pressure, so I was like, all right, it's gonna rip back down.
Yeah, this candle by itself, it's more like a bearish candle. you can see it in a different way. It's the buyers push it all the way up here, then the sellers were too strong to push it back down. So with the inverse hammer, you want to wait for the candle right after it. You want to see a candle at least covering 50% of the wick. If the buyers didn't fill 50% at least of the wick, there might be a chance that this is a bearish candle and we might keep downtrending. So with the inverse hammer, you need to watch the two candles, the candle that formed the hammer and the one following it. And I prefer to watch it. Yeah, I prefer to watch it on the 5 minutes at least.
I have a question.
Go ahead.
So on the hammer, if the second candles that forms, if it doesn't go above, I'm sorry, not that one, the one that you were just in before.
This one?
Yes. So the inverse hammer right there on the second candle, if it doesn't go, like you said, 50 above.
I wouldn't enter, no. Because that's mean there is still a chance that the buyer's sitting somewhere up here, maybe on the top of the wick, middle of the wick. But if I see the following candle closed 50% of the wick, I'd enter. I'd enter. The stop loss would be like right under this candle.
Thank you.
What time frame? You can use it on all the time frames. You can use it 5 minutes, 15 minutes, an hourly, 4 hours. Of course, a bigger time frame is more reliable than a smaller time frame. All right, then we go to the bullish engulfing. The bullish engulfing pattern is formed of two candles. The first candle is a short red candle, is a short red body candle, followed with a huge green candle engulfed by a larger green candle. So in this one, you want to see downtrend, then a medium size or a small size body candle with wicks, a wick to the downside, a wick to the upside, followed with a green candle. But you want to see a larger size green candle. And in this situation, I want to see a green candle, a huge green candle closing above the wick on the red candle. All right, again, so the bullish engulfing pattern is formed of two candles. The first candle is the short red body that is completely engulfed by a larger green candle. If you go on the weekly chart, you will see a clear bullish engulfing. On Google, on Amazon, on Tesla, you will see like red week, red week, red week. Then the week before this week, the past week, was a small red body candle with wicks on top of the bottom. And this week you'll see a huge green candle. This is what we call bullish engulfing. I'm gonna see how the open gonna look like on Monday. Yes, well, to see like a huge green candle, you must see some volume. If there is no volume, this huge green candle, it's not gonna get formed like that. So yeah, on the weekly, I'm watching the following candle that we're gonna start on Monday. If it's a green candle above of the Friday candle body, I take a long entry, or maybe you can take a swing. How do you know this isn't a healthy pullback for continuation to the downside? Well, this is what I'm saying. You need some candles, you need to use it in a bullish market. Some candles you need to watch it in a bearish market. Let's say we're in a bearish market. You don't want to play this kind of candles. You want to play the rejection candles. And well, the pullback, how want to explain it? Like a healthy pullback, I use it based on support and resistance. I don't use the candlesticks to measure if it's a healthy pullback or it's a sell-off or it's an uptrend. All right, so far, anyone has a question about what we just took? The hammer, inverse hammer, bullish engulfing, and the morning star. This one is kind of tricky because this one would always start with the doji. Doji is a small body candle with a wick on the top, wick on the bottom. It's undecision candle. So the morning star. Oh, hold on. All right, so the morning star, it'll start with a green, huge red candle. Doji, a huge red candle. So it's a doji followed by a big green candle, and the candle before is a huge red candle. So you want to see a big red candle, doji, huge green candle. This is what we call it the morning star. Your entry should be on the candle following the green candle. This sometimes can be a little bit tricky because of the doji. Like sometimes you'll see green candle, doji, then you'll start seeing a green candle start forming, and you're like, okay, this is a morning star. I want to take an entry. Then boom, flush back again. Why? Because it's a doji. It's really tricky. When you're watching a doji candle on a daily, your entry should be above the wick for calls or under the wick for puts. I like trading patterns. I sit in front of my monitor for hours just trying to identifying patterns. We'll go and talk about patterns a little bit, but yeah, I'm a big pattern trader. My chart is always filled with a trend line, uptrend channel, downtrend channel, bull flag, bear flag, descending triangle, ascending triangle, rising wedge. And I use the key levels just for a continuation or for a stop loss. But yeah, I consider myself as a big pattern trader. You gotta be careful catching the morning star. Again, the morning star. Oh, this is wrong. I need to fix this part. The morning star, you will see huge red candle, doji, huge green candle. Your entry should be above this wick. Once you break this wick, this is your entry. That's mean, okay, now we're in a valid morning star. Do I ever trade against the trend? I mean, I try not to, but it's depend. It's depend which trend I'm watching. Sometimes there could be a trend forming on the hourly, a bigger trend forming on the daily. I try not to trade against the bigger trend. Like if we're on a daily time frame, if we're still in a downtrend, but the hourly is forming an uptrend, I'm not gonna trade against the daily trend, not the hourly trend. Patterns and candlesticks. A bigger time frame is more reliable, and at the same time, it's a bigger move. So yeah, make sure you're watching the trend on all the time frame. Anyone has a question about those candle patterns so far? All good? All right. So all the one that we took, the morning star, bullish engulfing, inverse hammer, and hammer, this is a reversal from a downtrend. All the one we started with, you will see a downtrend, then followed by one of those four candles. Now we're gonna go to the reversal of an uptrend. We start with a hammer, a downtrend followed by a hammer. It indicates that we might flip to an uptrend. Now we're in an uptrend and we see the hanging man pattern. It's indicate that this candle the trend might flip. The hanging man is a bearish equivalent of a hammer, and it has same shape but form at the end of an uptrend. You'll see an uptrend, then you'll see a hammer at the end of the uptrend with a red body. This is an important thing, the red body on the top. The one with the hammer is a downtrend followed by a hammer. It indicates that we're gonna flip to an uptrend. Now this one is an uptrend. Hanging man, this is indicate that we might flip to a downtrend. I like using this one if I'm watching like on the 4 hours. I think that the buyers is struggling to keep pushing the trend. And as you see in this example, this red candle failed to close above the green candle right before it. And my entry would be if the same thing, if it followed by a red candle covering 50% of the wick. Got it? All right, we'll go next to the shooting star. We took the morning star, now it's the shooting star. The shooting star is the same shape of the inverted hammer, but it's formed on an uptrend. And it has a small lower wick body and a longer upper wick. Usually, in a situation like this, you will see a huge uptrend, then a gap up. Like let's say we opened right here, then a huge push. Then mid of the day to the end of the day, we start seeing some selling pressure somewhere in this area. By the end of the day, we see the close right under where we opened. That's indicate that those buyers that they were pushing the trend from the bottom to right here, then we gapped up, is no longer existed, or they're way weaker than how they used to be a day or two ago or 4 hours ago. It depends which time frame you're watching. But this one, it shows a weakness with the buyers. Like there is no enough buying pressure to continue the uptrend. Now we go again to the evening star. Evening star, it's the opposite of the morning star. You will see huge green candle, doji, huge red candle. Again, your entry should be on the candle that follow the red candle. If the third candle wiped out all the profit from wipe out all the profit from this candle and more than 50% of this candle, this is what I take a put signal. But again, I need to see it on a bigger time frame. I need to see it like at least on the hourly. Buying pressure, then suddenly it's just a doji. Oh, what happened to all the buyers that they were in those two candles? A doji is an indecision candle. All right, a doji, now watch the following candle. All right, under the wick. All right, now it's kind of bearish. We see this candle didn't close completely under this candle. If this candle closed below this candle, like wiped out all the profit from this candle, this is a bullish, this is a bearish engulfing. But in this situation, it's a green candle didn't wipe out all the profit. So we want to see the third candle taking all the profit from this candle and at least 25 to 50% from the candle before. This is when we know, okay, the trend might flip right here. But again, you want to see it on a bigger time frame. You don't want to watch it on the 1 minute, because it could be a doji, red candle, then green candle, and keep pushing. So we're in a bullish market. I don't really recommend taking any position based on an evening star, because there could be buyers sitting in anywhere. So we don't use evening star in a bullish market, we use in a bearish market. No, not really. it doesn't really mean anything because it's a small body. So if it's a green or red, it's a tiny body. It doesn't matter if you open right here, closed right here, or if you open right here, closed right here. A small body indicate that low volume and so much indecision. Buyers maybe is trying to take the price up, sellers trying to take the price down. So nope, it doesn't matter if it's green, red, or gray. All right, and the last one's going to be the bearish engulfing. We took the bullish engulfing where we see a downtrend, then a huge green candle engulfed all the profit, all the, oh my God. Then we see a green candle engulfed all the red candle. This one is the opposite. This one you'll see an uptrend, then you'll see green candle, then you see a huge red candle closed below the previous candle. As seen the one before it, we didn't close below the candle. That's why we waited for the following candle. But in the bearish engulfing, you see this, the first red candle wiped out all the gains from the previous candle. Well, it's depend, to answer your question, it just depend on what are you watching? Like you're watching a bear flag to break on the hourly, or watching a bull flag break on the 5 minutes. And it depends. If you're trading option, it's really hard to set stop loss. But I usually, like for a morning run, I used 40 to 60% stop loss. That's why I usually size light. For a day trade, I usually use 15 to 25% or 15 to 20% stop loss. All right. Anyone have any question about the candles? The first 4 candles, this is reversal from a downtrend, the hammer, inverse hammer, bullish engulfing, and the morning star, a reversal from a downtrend. Then the following 4, hanging man, shooting star, evening star, and bearish engulfing. This is a reversal from an uptrend. I like the bullish engulfing and bearish engulfing, morning star and evening star. I mean, it's all where you're watching, which time frame you're watching. The hammer could be really useful, but in this freaking market condition, we saw hammer so many times. Then the next day, boop, then the next day, flush again. But you can rely on any of those candle pattern on any time frame, on any larger time frame. It's all depend on the volume. You always want to see volume. For like a bullish hammer or bearish hammer, you want to see volume. If you're watching a bullish engulfing or bearish engulfing, you also want to see volume. Anyone has any question about the patterns? Do you guys want to take screenshot about the candlesticks pattern? No one? Okay. Now let's move to patterns. No, just a regular candle. It's only a candlesticks. You can't use it on a Fibonacci candle because Fibonacci indicate the momentum. So the closing and the opening is different than the regular patterns. Yes, I can do that. I mean, I have another slideshow. I have more than 25 pages about candles. But I don't know what's wrong with my cloud. So I had to work on this presentation yesterday. All right, now let's talk a little bit about patterns. I consider myself pattern trader. I like to identify pattern, bull flag, bear flag, pennant, double top, double bottom, triple top, triple bottom. And that's when I take my trades. Like 75% of my trade is based on 75% of my trades is based on patterns. I really like trading the patterns breakout. Yeah, I got you. I'll post the PowerPoint too. All right, so a chart pattern is a shape within a chart that helps to suggest what price might do next based on what they have done in the past. This is why we use patterns, just to indicate what happened in the past. So many times we saw an uptrend followed by a bull flag, or this shape that we start calling it a bull flag, then a continuation. The market did that many times. So now traders like, okay, so when we see an uptrend and we see this shape that we're gonna start calling the bull flag, it might, the buying pressure might continue. Or we see a downtrend, then followed by a bear flag, or what they start calling it a bear flag, it indicate that, okay, the market did that many times before. Sell off, bear flag, sell off. All right, so now we can use it because the market done that many times before. And as everyone know that the chart patterns are the basis of technical analysis. All right, so for the chart pattern, there is 3 categories: continuation pattern, reversal pattern, and indecision patterns. We're gonna start talking a little bit about the continuation pattern, a little bit about reversal pattern. The first continuation pattern, and this is my favorite, it's the bull flag. As you see right here, this is what we call the bull flag. A bull flag is, you want to see an uptrend followed by this shape, just like that. Then you will see a push. This is a continuation. This is a continuation pattern that occurs as a brief pause in a trend following strong price move higher. So, in a bull flag, you want to see an uptrend. Then we start forming a bull flag, then a continuation. How do we trade this pattern? How do you trade this shape? Your entry should always be above the upper trend. Your entry could be here, always above the trend. Yes, the quad bottom and the quad top. Yeah, well, with all of these, you want to watch the volume. There is a double top, triple top, and quad top, or double bottom, triple bottom, quad bottom. I'll show you where your entry should be on a double top, a double bottom, or the triple top, triple bottom. So bull flag is a continuation pattern that occurs as a brief pause and the trend following string price move. I really like trading bull flag and bear flag. Again, for those patterns that we're gonna study today, you need to use this one and the better market. Like the bull flag is bullish at the bullish pattern. So you want to use the bullish market. You don't really want to use the bearish market. A bear flag is a bearish market. You want to use it more in a bearish market, not in a bull market. So for the last month and a half or 2 months, I'm really bearish. So I'm only counting on the bearish pattern. We'll talk more about it. Are you guys all familiar with the bull flag? What about the other? Are you all familiar with the bull flag? It is one of my favorite too. If you want, you can take a screenshot. All right, so for entries, should always be above the trend, with the stop loss is below the downtrend. I also used on all time frames. In my examples, you will see a different time frame. Like this one, I use it on the 1 minute time frame, or maybe like 2 minute time frame. Yeah, this is what I'm saying. The entry should be once we break the upper trend, stop loss should be under the bottom trend. Or your entry could be when on the touch on the bottom trend with a stop loss right underneath it. It's depend how familiar you are with patterns. Oh, no. I meant to say above the upper trend. The green one is the upper trend, the red one is the lower trend. My entry always be above the green trend. And my stop loss would be below the red trend. As you see right here, like I'd enter right here or right here. But a fake out, well, maybe in this example right here, it could be a fake out. Any of those pattern, it could be a fake out. So when you're buying the breakout, you want to see a volume kicking in. I usually use the volume average on 5 candles, so indicate the moving average on the last 5 candle. So I want to see the breaking candle to break the volume average. This is when I take my entry. Or if I'm watching bull flag on a bigger time frame, I might take an entry bouncing off the bottom trend. Like we're gonna form a bear flag. If any of those touches for the bottom trend, like form the hammer, I take an entry on the bottom trend with the stop loss below it. I used on all time frame. With patterns, well, the bigger time frame is more reliable, but you can use it on any time frame. This bull flag right here is the 1 minute. 1 minute Tesla, I believe. Yep, it's the 1 minute on Tesla. Anyone have a question about how to trade a bull flag? Entry, stop loss, take profit. Okay, I forgot to mention the take profit. Well, this example is unique because Tesla made a huge move, unbelievable move. But usually the take profit is from where the movement started. The same, which is in this example 3.14%. Once we break, we should see 3.14% move. So entry above the upper trend, a break the upper trend with the volume, stop loss is below the bottom trend, then the profit target should be the same move that we saw before we start forming the bull flag. Yes, you will get way more faked out on the 1 minute. That's why I don't watch the 1 minute at all. The only time I watch the 1 minute is when I'm trying to find an entry. Once I enter my position, I only use 2, 3, or 5. And I'm always watching the 15. So let's say I'm trading this Tesla. Now I'm watching a bull flag. I'll switch to the 1 minute just to find an entry, then switch back again to the 3 minute to keep watching the trend. And on the other side, I'll have the 15 minutes or the 30 minutes or the hourly. It's depend what is my plan for this trade. Like sometimes I'd be watching, okay, so the 15 minutes is flagging. So I take my entry on the 1 minute, then I flip to the 15 minutes so I don't get faked out. No, not really. So probably in a day like this, we formed this bull flag, but if you switch on a bigger time frame, like hourly or 4 hours, it just one huge green candle. So that's why you need to watch it on all the time frames. Usually when I'm charting, I go on a weekly and try to see if any familiar patterns is there. Then I go to daily, 4 hour, 15 minutes. Then of course, intraday, I try to find like, okay, bull flag on the 1 minute, a bear flag on the 5 minutes, which is mean might be a smaller move than the one that I'm watching on the hourly, 4 hours or whatever. All right, so the bull flag is the first continuation pattern. What if patterns form in a small time frame, bullish, but the bigger time frame hasn't flipped and it's still bearish? In this situation, I'll rely on a bigger time frame if I want like day trade or swing, or maybe I'll just scalp the smaller time frame. But in this situation in Tesla, there was a downtrend. Tesla broke the downtrend right here. There was downtrend, Tesla push, had the trend line right here, then we continue. So the bigger time frame was downtrend channel, then we break the downtrend channel, then this is continuation pattern intraday. Yes. Yeah, but with patterns, you could fall in a breakout and a fake out, sorry. It's really easy to get faked out. But as you can see right here, the risk to reward is always huge. Like you're entering right here, your stop loss would be right here, let's say 15% stop loss, just for an example. But the target is huge. The target is 100%. So in this example, you're risking 15% to make 100%. So it's a good risk to reward. Risking 50%, 15% to make 100%. So if we got faked out right here, like in this example right here, this was a fake out. Let's say you entered right here with the stop loss right here, and the trend flipped. You'll put your stop loss right here, maybe lose 15, 20%, but I mean, it was worth the risk. We saw 3.14% move, so we're expecting another 3.14% move. Anyone have a question about the bull flag? All good? This is, oh, what was the name of that tool? Where's my phone? I think it's a long something. Give me 1 sec. This tool, you can only find it on TradingView. Long position and the short position. If you want, I can send you all those tools. Like I'm using a trend. This is a long position, and this is just to measure the move. Do I use a 10% of the current price? Usually I'll just watch the pattern. Like I'm playing this bull flag. My target is 3.15% move. I take my entry right here. My stop loss would be below the trend. Now we see a push, we trim based on the support and resistance, or based on a trigger prices, we trim right here. I'd set my stop loss a little bit above my entry. So if you pull back again to this area, testing the support level, which is right here, I'd hold it. Below this support line, I'd sell it. So it's really hard to say if it's a 10% away or 20% away, especially when you're trading options. Sometimes when you're trading option, it gets intense. Like one candle will make you 50%, one candle you'll lose 50%. So it's really hard to like set a percentage stop loss. All right, so this is a bull flag, continuation pattern to the upside. Now this is a bear flag. Nope. The bear flag, it's the opposite of the bull flag. Bull flag, you will see an uptrend forming this black shape, then the bull flag shape, then break the trend line, continue to the upside. This one is the opposite. You will see a sell-off, then forming this shape. What we call it right now is a bear flag. Then once we break the bottom trend, we'll see another sell-off. And you can see in this example, it's more clear than the bull flag example. I think this was on Google. A sell-off 5.17%. We formed this bear flag. Your entry should be under the trend line. Stop loss above the upper trend. Now we use the price range tool to measure the movement. Like we saw 5% sell-off, we might see another 5% sell-off. And it was clear in this example. 5% sell-off, bear flag, we broke under the bottom trend, another 5% sell-off. Again, you might get faked out, but the risk to reward is always there. Like you're entering right here, stop loss could be 15 to 25% if we break the upper trend, but the target is big. Like in this situation, it was a 117 points move. If you can catch the whole 117 points move, this could be anything between 200 to 600%. Anyone has a question about bull flag or bear flag? They're both continuation pattern. Bull flag continuation to the upside. The bear flag is a continuation to the downside. And again, you gotta know when to use those patterns. In a bull market, you don't want to count on a bear flag. You want to count more on a bull flag. On a bearish market, you want to count more on the bear flag than a bull flag. Anyone has a question about bull flag or bear flag? A good time to take profit. Honestly, I trim based on the daily levels. Like I don't have any daily levels on trading view, but I trim based on the daily level, but I always make sure I leave a runner because my ultimate target is down here, the same move. Maybe I'll trim if it's depend on how much I'm sizing. Like if I'm taking one contract, I just hold it till we hit this point. Like I'm either gonna lose 20 or 25%, or I want the 200%. If I have more than one contract, 5, 6, 10, 15, 20, whatever, I trim based, the first trim I take on the bottom of the bull flag, on the bear flag, then maybe I'll take 1 or 2 trims. It's depend on the trigger prices that I have, or if there is like a support or resistance area. But I always hold a runner to the end of the target. Well, it's again, it's not always going to be perfect like that. Sometimes you'll see a sell-off, bear flag, then we just hit the bottom of the bear flag, then bounce back again. Anyone have a question? Bull flag, bear flag? One is a continuation to the upside, the other one is a continuation to the downside. Did I answer your question about taking profit? I use the wicks. If there is a fake out candle, I don't count it. I don't really rely on after hours or pre-market move. I draw my patterns based on day trade. And I use a trend line to touch at least like 2 to 3 wicks. If you have any question, mute yourself and talk to me before we move to the other patterns.
So are you using the chart for a stop loss or an actual percentage?
No, I'll use the chart. I use the weighted moving averages, 50, 113, and 200. And I use the RSI just to see if there is any hidden bullish or it's like hidden bearish. All right, so now we took the bear flag, bull flag, both are continuation patterns. Now let's move to the ascending triangle and the descending triangle. An ascending triangle, as you see right here, it's forming a triangle. You will see a higher lows. This is a low, a higher low, higher low, higher low. But we're rejecting on a same exact price, 1, 2, 3. So this is a clear ascending triangle. Ascending triangle is a type of triangle chart pattern that occurs when there is resistance level and slope of higher lows. So again, you want to see a higher lows and the same resistance level. Your entry should be once you break the resistance level or retest the resistance level with a stop loss below the bottom trend line. So you want to see higher lows with the same resistance level. When I see higher lows, same resistance level, okay, this is an ascending triangle. My entry gonna be above this resistance level, or once we retest the resistance levels, depend on the volume. You also want to see a volume kicking in right here. If you see massive volume, we might see a continuation right away. If we saw a tiny bit higher volume than when it used to be right here, that's mean, okay, we might see a retest. So your entry should be at the breakout or at the retest. For the profit target, you measure from the resistance to the bottom of the support. The same move, you should see it again once you break out. So this one right here was an 11%, 11-point move or 1.8%. We saw the exact same thing, 12% move or 1.88%. So for the ascending triangle, do you have any question about entry, stop loss, take profit? Again, maybe I'll take small position on the breakout, trim once we see a rejection, maybe re-enter again on the retest, then trim, and I always hold the runner to hit the target. It's a continuation pattern. Maybe the example is not really clear, but yeah, it's a continuation pattern. I mean, as you see right here, this is an uptrend. higher lows. So it's an uptrend and we continue the uptrend. How do we confirm breakout? What I personally use is I use the 2 minutes or the 5 minutes, depend on the time frame that I'm watching. But let's say I'm watching this on the 15 minutes time frame. I watch the 5 or the 3 minutes for an entry. I want to see green candle, a break and hold the resistance level, which is the green line right here. I want to see a green candle hold the resistance as a support, followed by a bigger green candle with a volume. You always want to see volume kicking in on the breakout, either bull flag, bear flag, ascending triangle, descending triangle. You want to see a volume. I mean, you don't really have always to play the breakout. You can play the retest. And if in this example, it's really clear that this was the breakout. This is the retest right here. As you can see, we formed a hammer candle. Like once we hit the resistance again, acted as a support, we formed the hammer candle. This could be a good indicator for an entry. Yes, well, after the hammer, yeah, I want to see an uptrend start from the hammer. I don't want to see candle closing under the body. I want to see candle above the body. And for the trim, if I entered right here, I take a trim because we rejected this resistance level before. I'll take a trim right here. Maybe I'll take another trim right here because it's an intraday level. But I always make sure I'm holding a runner to see if we're gonna hit the ultimate target, which is 1.84%. And it worked again, 1.84% move. All right, now we go to the descending triangle. It's gonna be same. Why would you move pure stop loss? All right, so I'll enter right here. Or let's say I entered right here. My stop loss would be below the trend, a tight stop loss. If I'm already playing the breakout or if I'm late on the breakout, I'll use the previous resistance as a stop loss. If it acted as a support, like in this example, I'd buy more. But if it didn't act as a support, I'll use this level as my stop loss. Once I take the first trim, like let's say I re-entered right here, I took the first trim on the previous resistance level, my stop loss would be like right here. Then I took a trim right here. If the price keep pushing, this level right here would be my stop loss. Or maybe I'll give it more time to breathe. I'll use this level right here as my stop loss. You're welcome. All right, ascending triangle. Now we go to the descending triangle. It's the exact same thing, but it's an upside down. You will see a lower high, high, lower high, lower high, lower high with the same support level. Right here, the one before it was a higher lows with the same resistance level. Now it's a higher lows, and now it's a lower highs with the same support level. It's going to be exact same thing. My entry would be below the support level. Stop loss would be above the resistance level. This is for puts. And you for the move sizing, we take the whole move from the highest high to the support level. We should see the exact same move again. You can enter at the breakout, or you can wait for retest. In this example, you'll see this is a retest candle. Again, my entry would be under the support level, stop loss above the resistance level. We can enter at the breakout or retest. And for the profit target, gonna be the same from the highest high to the low, exact same move. Oh, this is a little bit bigger move. This is 17%. My target should be 17% move. Or a dollar amount, it's 2.9 points move, another 2.7 move. Anyone has a question about descending triangle and ascending triangle? By the way, Tesla on the 15 minutes, I'm seeing an ascending triangle. I'll post on my watch list. On the 15 minutes or the hourly, I think, you will see higher lows and you'll see the same resistance level. So Tesla gonna be my main watch list for Monday. I wanna be watching an ascending triangle play. All right, so bull flag and the bear flag, descending triangle and ascending triangle, both are continuation pattern. Now we're gonna talk a little bit about the reversal pattern. Anyone has any question about continuation patterns before we move on? All right. Now we're going to talk a little bit about falling wedge and the rising wedge. A falling wedge is a bullish pattern that begin wide at the top and contract price move lower. As in this example, you'll see a downtrend. Then we'll start forming a lower lows and a lower high. But you will see the high, the lows is getting higher, but the high is, hold on, let me put it in the exact.
You gotta call desk to get in. Nah, nigga, it's a stand-up desk. It goes up, I walk under, it comes back down.
All right, a falling wedge is a downtrend followed by this shape. This shape is called falling wedge. You'll see an aggressive downtrend, a bounce, downtrend, another bounce. Usually the falling wedge or the rising wedge, I'll count on the 3 or 4 touches. And this situation, 3 touches, 1, 2, then 3, and go. Your entry would be above the upper trend or the resistance line, if you want to call it. Stop loss should be under the lower trend or support or the support level. Falling wedge and rising wedge is a reversal patterns. So when you see a downtrend ending with a falling wedge, you should be like, okay, could be a reversal sign. We're gonna break the downtrend again to the uptrend. For the profit target, it's gonna be from the top to the bottom of the falling wedge. So in this situation, it was 12 point to the downside. We entered at the breakout. You can wait for retest, or you can take the breakout. The ultimate target is the 12%. What if the price breaks the lower trend and then again comes inside the triangle? In a situation like this, if we're gonna break the bottom trend or the support, if it's gonna break the support level, it's gonna keep trending down. So it's an invalid falling wedge. Maybe you can play it as a fake out. So we break below the resistance, below the support, sorry, like right here. Then we see the volume start kicking in. Maybe you can take some calls because it could be a fake out potential, but I don't really recommend it. I always wait for a safer entry. Your entry always could be on the touches of the support trend, the support trend line, but it's the early entry. Your safer entry is when we break the resistance level, the resistance trend line. This is the safe entry. You can take your position right at the breakout or wait for retest. And this example is really clear. We see a push, breakout, retest, then go. So this is a reversal pattern. I'm sorry about this example. This is the only example that I found. But, oh, I forgot to mention something. If you're trading the falling wedge, when we start this choppy move, you want to see a volume increasing. But for rising wedge, it's an uptrend, then we start chop around. You want to see the volume decrease.
Who's that? Her mom?
You want to see a volume decreasing. If you see like an uptrend, then we chop around, volume is decreasing. Okay, could be a potential rising wedge. Your entry should be once you break the support trend line, resistance, stop loss is above the resistance line. And the profit target is going to be same thing from where the movement started to the top. It's not a very clear example. I'll update it later. Anyone have a question about rising wedge or falling wedge? Yes, I'm watching SPX on. I'm seeing a rising wedge on SPX, but if you go on a weekly chart, all the tickers is forming a bullish engulfing on the weekly. Amazon, Shopify, Google, Facebook, Tesla. So it's all depend on tomorrow move. If we see some serious volume, I want to be taking calls for the end of the week. If the volume died down, I'm gonna send puts till the end of the week. All right, and again, we have a double top and a double bottom. I didn't find any clear example for a double bottom, but I have an example for the double top. A double top is an extremely bearish technical reversal pattern that form after an asset reach a high a high price to conservative times and declined. In this example, this is Roku on the daily, I believe, or like a weekly chart. I forgot which one I used. We hit the high of, I believe it was like 480. Then we declined, we rejected an aggressive sell-off at the 480. Then we tested the same area again. As you see right here, we rejected the 480 again, the exact same area. I'm like, okay, now it's a clear double top. I mean, it's not clear double top unless we break the neckline. If you're trying to play a double top or the double bottom, you can play the rejection, but this is not a double top or double bottom. Double top, if you want to play it, it should be right below the neck. As you see, this is the neck, or this is a support area right under the support area. This is your entry for puts with a stop loss above the neck again. The profit target should be, once we break the neck to the downside, we must go back where the move started. Like see the uptrend started right here. Under the neck, we're gonna keep trending down till we hit the same area again. Double bottom gonna be exact same thing, but you will see the ticker is bouncing off resistance. All right, let's take this example. Forget about this red candle and everything after it. And you'll see 1, 2 touches, then a bounce. Your entry should be above the neck, which is right here. Stop loss is below the neck. Profit targets where the movement started. And double top, double bottom as a reversal pattern. Anyone has a question about candlesticks and patterns? There is so many candlesticks patterns and there is so many patterns. Those are my favorite. If you want, in the upcoming weeks, we can talk more about more patterns and more candlesticks pattern. Yes. Anyone has a question? If you have a question, unmute yourself and talk to me. All right, all right. Okay, everyone, we're gonna call it a day right here. I want everyone to start looking for patterns. Try to find a bull flag, bear flag, ascending triangle, descending triangle, falling wedge, riding wedge, and send it to me on Discord. Thank you, everyone, for showing up. If you have any question, I'll be on Discord. I'll see you all tomorrow on VC. And I go back on one slide. Yeah. This one right here. Yep, the class is already being recorded. Someone was asking me to go back and chart. Can I go back one slide, please? Okay. All right, I'll see you all tomorrow morning on VC. And enjoy the rest of your day.